All right, let's quickly take a look at the RBA rate decision coming up tomorrow morning. Now, this time on this calendar we are looking at is SAST time. That is 6:30, but that means 5:30 BST and 12:30 EST. So just keep that in mind for tomorrow. Now, tomorrow's decision for the RBA is going to be an interesting one, not only because of the recent inflation data that we've had, but more so because of what the inflation data has done for rate expectations. So as always, let's start with what is expected from the RBA, because once we have that, it'll help us to get an idea of what we would need to see tomorrow from the bank to give us a high probability trading scenario to try and take advantage of. So heading into tomorrow's meeting, there is an extremely low probability assigned to any change in rates. I mean, we've got a 92% probability of a hold, but there is an 8% implied probability of a hike. And if we look towards the end of the year, we can see that the markets are implying about 8 basis points worth of tightening by year end, which is about a 67% chance of a hike. Now, think back to just a few weeks ago. Just a few weeks ago, this type of shift would have seemed highly unlikely. But we've been looking for upside risk in the Aussie for the past few weeks now, on the basis that the markets were underpricing the risks of a higher for longer RBA. I mean, it gave us some really good trades, trading the Aussie versus the Kiwi, the dollar, the Swiss, the pound. But heading into this meeting, I do think that maybe there is a bit of a potential downside risk for the Aussie based on what the markets, how the markets have changed their view on Aussie rates. Why do I say that? Well, even though there's a very slim chance, according to interest rate markets here, of a hike tomorrow, there are actually 1 or 2 participants calling for a hike tomorrow. And there's a few others calling for 1 or 2 or even 3 hikes later in the year, which I think is taking things a little bit too far. I anticipated the markets to reprice a higher for longer RBA. I think that was underpriced, but pricing in more hikes from here, I think that's taking things too far based on one inflation print. Just like with the Fed last week, I think there is a risk that markets have taken sentiment on rates a bit too hawkish. And that means that even if the bank does what in my view is the most rational thing tomorrow, which is just doing nothing and making no changes to the statement, even that could now be seen as dovish by the markets because of the hawkish expectations that we've seen building up. In other words, markets might have been getting a bit too hawked up for tomorrow, expecting the bank to put hikes back on the table, just like the Fed, and we might not get that. And I mean, don't get me wrong, inflation printed much higher than what the markets anticipated last week, right? Or 2 weeks ago. If we take a look at that Aussie CPI, both the weighted median, quarter over quarter, year over year, as well as the trimmed mean, quarter over quarter, year over year, all 4 of them printed above the market's maximum expectation. So there's no doubt that, yes, that was hot CPI numbers. But if we look at the charts as we did earlier today, you cannot argue that we haven't made progress. Looking at trimmed mean, did we surprise above market expectations? Yes, we did. But we still decelerated, right? From 4.2 down to 4. In terms of the weighted median, that looks less sexy, but staying flat at 4.4 doesn't mean we're moving in the wrong direction. So arguably they're still making progress. It's just not moving in the direction as fast as they would have liked it to. And for me, this really resembles what we've been looking at for US CPI, where everybody's been freaking out about, hotter than expected, hotter than expected, hotter than expected. Yeah, it's been hotter than expected, but the trend hasn't changed. Looking at core CPI and core PCE. Can this change and move higher? Yes, it can. But right now, we're not seeing that yet, right? So in the same way that the markets, in our view last week, took the Fed, expected the Fed to be too hawkish, I do think there's a similar type of risk for the RBA. Not as aggressive as they were with the Fed, but it's definitely been building up from a sentiment point of view. So, if I was the RBA, if I was looking at these charts, would I really want to react based on one quarterly CPI print? Or would I want to rather give myself some flexibility? You would opt for flexibility in this situation, right? Because the next print, right, might be going down even more aggressively. We just don't know. We need to wait. So I think based on the recent statement, I do think they gave themselves enough flexibility to not have to change anything tomorrow. Let me show you guys what I mean. If you take a look at the 2 statements here, the one on the left is the one from February, where the one on the right is the one from March. Now remember, recall back in February, their view on rates was still tilted towards hikes, right? By saying that further increases in rates cannot be ruled out. They then changed that to a more neutral, more data dependent, more, let's call it flexible or optionality based statement in March by saying that the board is now not ruling anything in or out, which could mean either hikes or cuts based on the incoming data. So by saying that they are open to any direction for rates, I just don't see why one CPI print has to change that tomorrow for the RBA. Yes, they should acknowledge the higher surprise in core inflation, but they should also acknowledge that, even though it's been slower, progress has still been made. It's just not as fast as we would have hoped it to. So I think that poses downside risk for the Aussie if the bank leaves their statement unchanged on rates guidance and doesn't open the door to hikes again. Obviously, if I am wrong with that and they are hawkish, well, obviously we'll know how to trade that, right? We'll trade the Aussie higher in line with that medium view that we have. But in that sense, I think there's a real downside risk if they just come out and they do absolutely nothing tomorrow. But let's quickly take a look at a few scenarios that we always do coming into these types of events. So in the middle, we've got the baseline, which we think is the most likely outcome based on consensus view. Then we'll look at what would consist a dovish shift from the bank and what would consist a hawkish shift. So let's start with the baseline. In terms of rates, markets are expecting rates to be held steady and a neutral hold. So we'll explain what we mean with a neutral hold. With the neutral hold, we mean that in terms of guidance on rates, the statement remains unchanged and they stick to their guidance that the board is not ruling anything in or out. Again, whether hikes or cuts. In terms of the recent data, expecting them to say things like, well, recent inflation data were higher than expected and remains too high. The data still suggests that inflation is continuing to ease, albeit at a slower than hoped for pace. Now, that shouldn't really trigger anything for the Aussie in a normal environment, right? Because that's not much of a change from the prior statement. But because the markets are now expecting something more hawkish, even this in itself would be seen as a slight dovish tilt from the bank. So that is important to understand, right? It'll be seen as dovish, even though it might not really be dovish because they're not really changing anything, right? What about a dovish shift? Well, for a dovish shift, again, we're expecting rates to be kept on hold, but they're expecting it to be a dovish hold, meaning that in terms of guidance on rates, they could say that the balance of risk for rates are more skewed towards the lower end, towards lower rates as opposed to higher rates. That'll be unlikely, but we need to prepare for these scenarios. And in terms of recent data, they could say something like, downplaying the upside in inflation data as just being one print, and it doesn't change the board's view from March. Again, this will be a slightly more dovish shift, obviously giving us the higher conviction. Baseline could still give us a trade, but it's going to be a slightly, it's not going to be as high of a conviction trade compared to a dovish move. Then in terms of hawkish, look, it's very unlikely that the bank hikes rates tomorrow. But we need to prepare for that eventuality, right? We need to prepare for that scenario. The last thing that you want to do going into tomorrow is being so sure that they don't hike, and then they hike, and you don't know what to do. You're just sitting there, should I trade, shouldn't I trade it? Obviously, if we do get a hike, that's going to be a very high conviction long in the Aussie dollar. That's something obviously worth watching out for, but it's going to be an unlikely outcome on the rate side. What about guidance on rate? Let's say that we don't get a hike. What could still be considered as being hawkish? Well, if they say that the balance of risks for rates are now more skewed towards higher rates again after the recent surprise in inflation, right? If they shift their statement once again, from this one on the right to this one on the left, then obviously that'll be their way of saying, oh, well, okay, that inflation data we had, that actually skews us more towards higher rates again. If we get that, that'll obviously be a hawkish trigger as well. And in terms of recent data, if they voice real concerns about the recent upside surprise, saying that inflation will take much longer to get to target than previously anticipated, that'll be them nudging us towards possible higher rates, saying that, we think it's going to take much longer than previously thought, and that means we're probably going to need higher rates. Now, what can we look to trade in either one of these scenarios? Well, in terms of the baseline and the dovish view, I would look for two opportunities. The first one would be Aussie Kiwi shorts, and the other one would be Euro Aussie longs. Now, just keep in mind, this one is high conviction. This one in the middle should actually be lower conviction, short short Aussie Kiwi Euro long. So there's a bit of a typo there. So just keep that in mind. In terms of a hawkish surprise, I'll be keeping it simple. I like the dollar lower this week, so I'll be looking for Aussie dollar long. So let's quickly go to the charts then. And let's start with the Euro Aussie. Why do we like the Euro Aussie as a long if the RBA comes in unchanged or dovish? Why Euro Aussie longs? Well, there's a couple of different reasons, but I do like market internals here. We're pushing into a key level of support around that 160. Let's just call it the 160-250 area. Now, why is this level significant? It's not the level itself, but it's how various market internals have changed around this low. So for example, if you take a look at something really simple like growth differentials between the euro and the Eurozone and Australia, you can see that the recent push to the downside in spot has not been reflected in growth differentials. They've actually moved in the opposite direction, suggesting some upside risk for the pair. Furthermore, if we take a look at something like real yield differentials, which is just nominals, but stripping out, adjusting for inflation, if you will, you can see that there's a big differential here between what real yield differentials are showing us, or divergence rather, between what real yields are showing us and what spot price have done. So there's also some potential upside risk. So it's not just us looking to buy something from a key bounce at a key support level. There's actually market internals that suggest there is some upside risk for the pair as well. What's great about getting long a dovish RBA tomorrow with something like this is that you have a very clear level to limit and define your risk with. If we break below that, then we know we're wrong, which means there's more, it gives us a more attractive risk reward on a trade like that as well. The other one that I quite like for very much the same reasons, but there's some changes there, is Aussie Kiwi downside. I mean, we've had some brilliant trades in this over the course of the last few weeks. What's interesting here is that even though market internals are not as strongly suggesting downside risk as it is upside risk in the Euro Aussie, what we like about this pair is that something that you need to know about the Aussie Kiwi is that it has been stuck in a massive range basically for the past 6-7 years now. This pair always oscillates, and we normally use the 108 level as the mid-range. So whenever we get a little bit too far in the short term away from that 108, we tend to have a higher probability of looking for mean reversion trades. Now, we've had a couple of great ones. We traded this low actually going back to May 23. We traded this pop to the upside back in October 23. More recently, we traded this bounce low. We traded this one higher, this one higher. And right now we're getting to levels where some mean reversion shorts is starting to look more attractive to the downside. We don't just want to be shorting it for the sake of it, right? We want to have a good reason. And what is a better reason than a more dovish than expected RBA, or an RBA that sounds dovish, even though they might not be, as we explained, and that giving us a reason to short the pair. So also, just like the Euro Aussie, we basically at the recent high, so it gives us a nice area to limit and define risk. And looking for something simple, like a move back down towards the 109, 109.30, I think could be something on the cards. Now, what about the other option? If we do get a more hawkish RBA, I think Aussie dollar longs is just, the most simple one to look at. We're expecting some downside risk for the dollar in a week like this. Yes, the pair has gone pretty far, and we are testing major resistance right now around that 66.30, 40. It's these recent highs we've been slamming up against. But if the RBA comes out hawkish tomorrow, there's arguably, think about it from a flow perspective, there's arguably a ton of stops sitting around the zone somewhere. So if we do get a hawkish one, that could give us a nice big trigger to the upside, potentially opening up some room back up towards that 67 cents level, maybe even higher. So I think Aussie dollar longs probably the best bet on a hawkish RBA. And if we get a dovish one, Or like we said, in line with the baseline, I'll be looking for Aussie Kiwi shorts and potentially Euro Aussie longs on that front. So that's just a preview and a trade plan for that RBA decision tomorrow. As always, any questions, don't hesitate to let me know.